everybody who is building these chatbots and generative AI, when you're ready to run it, you're going to need an AI factory. And nobody is better at building end-to-end systems of very large scale for the enterprise than Dell. And so anybody, any company, every company will need to build AI factories. And it turns out that Michael is here. He's happy to take your order.
Dell. Well, what happened with Dell? On Friday, the stock was down 20%. Of course, with the last, I think, hour or so of the market, everything went back up, but the stock was still down 17.87%. Of course, its performance year to date is still quite amazing. It's up close to 84% year to date. Year over year, the stock has gone up over 200%. And so right now we have a market cap of just under $100 billion, forward PE 16.6 times. Now, if we currently look at the forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, you can clearly see that valuations are quite stretched, especially if you compare it to its 5-year mean. But on the flip side, if you look at price earnings to growth, it sits at 1.21, which is lower than where it was back in March 17, 2023, where the forward PE, EV to EBITDA, price to sales were all lower than its 5-year mean. So right now there is more growth expected than before. Because if we actually look at the analyst estimates for the coming fiscal years, fiscal year 2025, sales growth of around 8.7% year over year, but EPS growth only 8.2% year over year. But that's followed by a big reacceleration, 20.7% year over year growth for EPS in fiscal year 2026, and then another 17.12% year over year growth in fiscal year 2027. Of course, we know why that is. The intro should explain it. Now, another big player in the AI servers market is, of course, SMCI. Now, SMCI, if we compare it here to Dell Technologies, forward PE is higher. EV to EBITDA is higher, price to sales is higher as well. Price to free cash flow, right now, it has no price to free cash flow in the last 12 months. But if we look at price earnings to growth, it is much, much lower. It's at 0.52 compared to 1.21 for Dell. Why is that? Well, here you can clearly see EPS growth growing much faster than what we have just seen for Dell. So after all of this, why did Dell crash, right? Why did Dell crash on Friday? Were earnings that bad? Is suddenly the momentum completely gone? Is there no demand for AI servers, AI factories? What exactly has happened? Well, for the quarter, a tiny miss with regards to earnings estimates, but a beat with regards to revenue. So what does that mean? Well, as always, it has to do with guidance. And with that, we're going to cover in just a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And if you want to know the answer of the title, no, I don't think it's an issue for Nvidia. I think the demand is still quite strong, and so demand for Nvidia products is going to be strong as well. And so if we start off here with the Dell AI Factory with Nvidia, the industry's first end-to-end enterprise AI solution. Now, the Dell AI Factory combines Dell infrastructure, solutions, and services optimized for AI workloads with an open ecosystem of partners, including Nvidia, Meta, Microsoft, and Hugging Face. So of course, it's not just Nvidia, but I would assume that Nvidia is their largest partner. So you're always going to hear Dell talk very, very positively about Nvidia, and Jensen Huang talk very, very positively about Dell, about ServiceNow, about Microsoft, etc., etc. And so if we look at some highlights for the quarter, I'll start off with the strong cash generation and capital return. They generated $1 billion of cash flow from operations driven by profitability and partially offset by our annual bonus payout. They returned $1.1 billion of capital to shareholders through $722 million of share repurchases and $336 million in dividends. With regards to AI-optimized server momentum, orders revenue increased to $2.6 billion in Q1. There were $1.7 billion of shipments in Q1, growing over 100% quarter over quarter. Backlog exited Q1 at $3.8 billion. That's growing approximately $900 million sequentially. AI-optimized server pipeline grew quarter over quarter again and remains a multiple of our backlog with expansion in number of enterprise customers. And so, revenue for the quarter increased 6% year over year to reach $22.24 billion. Operating income is down 14%. Diluted earnings per share is up 67% year over year. As for the two segments, first segment, Client Solutions Group, revenue there is basically flat year over year, and operating income is actually down 18% year over year. Infrastructure Solution Group, that's where the huge increase comes from. So the revenue increased 22% year over year, but operating income is still down 1%. And that's basically the issue, the small miss already for this quarter, which, by the way, Q1 is a seasonally weak quarter for the company. But gross margin as a percentage of revenue is 21.6%. That's down 4% year over year for gross margin and 10% quarter over quarter. They also missed gross profit margin estimate by around 120 basis points. But overall, revenue is not affected. As we've seen in this quarter, revenue beat estimates. Revenue for the full year is not an issue either. Why is that? Well, first of all, it has the momentum with it. It's one of the best out there. It works with the biggest companies, the biggest partners, the biggest ecosystem. I mean, you've got here Nvidia, Microsoft Azure, Qualcomm, AMD, Intel, Meta, etc., etc. They say they have the best-in-class total cost of ownership, 75% more cost-effective inferencing than public cloud. Now, again, so what's the problem? Why is the stock down? If revenue is fine, if growth is fine, the momentum is all great and well. What's the big problem? Well, the problem is something we have known already when we covered Dell, SMCI already the first time. The problem here is that these types of businesses are low margin businesses. And now, with a lot of competition, with AI servers not being that profitable, you don't want your products to be that expensive to scare off the customers, of course. And so margins are getting hit. More specifically, for year 2025, they now expect non-GAAP gross margin rate to decline roughly 150 basis points given inflationary input costs and a higher mix of AI optimized servers. So AI optimized servers, great for revenue growth, no problem, but not that great when it comes to profit margins. And that's basically the whole issue here, because revenue for the full year is expected to be between $93.5 to $97.5 billion. So a midpoint of $95.5 billion, beat analyst estimates, no problem there. Revenue for Q2, midpoint $24 billion, no problem there either. Again, the problem here lies with EPS, in this case, non-GAAP diluted earnings per share expected to be $1.65. That's below consensus numbers. And as for the full year 2025, non-GAAP diluted earnings per share is expected to be $7.65 plus minus 25 cents or so, which again is below what analysts were expecting. And so right now, what do we get? Well, you got that huge dump on Friday, close to 20%, but we've seen a solid rebound of that 50-day moving average, which sits at $132. Of course, like I said, in the last hour or so of the day, the stock did recover quite a bit, but this is on the daily. The 200-day moving average sits at $97.16. Actually, if we switch to the weekly, you can maybe see it a bit clearer right now. As you can see, we were overbought before they reported earnings, but being overbought does not always mean that you cannot go higher. As we've seen here in February of this year, stock was also overbought, and yet the stock ran up no problem. But right now, after these earnings, stock took a dip, big red candle for the weekly here, like we said, rebounded off that 50-day moving average. And now we wait and see if it can stabilize around these areas, so RSI can go back down a little bit lower, because it has been quite a while since RSI was lower. It has been very high, if not close to almost always overbought, already since June of 2023. So close to a year ago, RSI has either been overbought or very close to being overbought. But like I said, that didn't stop the stock of going up 3x. And so to conclude, is Dell's earnings or the stock's reaction something bad, a bad sign for Nvidia? In my opinion, no. Does Dell still have its momentum? In my opinion, yes, despite the margin hit. But this is again something that we have discussed in the past. SMCI, Dell are not high margin businesses. And if they want to grow, if they want to take market share, one of the ways to do that is, of course, take a hit when it comes to margins. We've known that. But Dell also has something extra, something that SMCI does not have, and that's the fact that we're going to get a huge PC refresh cycle. It's already starting right now with the announcements of the Qualcomm laptop with Copilot from Microsoft AI PCs. It's going to be a huge wave, and this is something that Dell will benefit from, something that SMCI will not. So overall, that's about it. If you enjoy this type of videos, leave it a thumbs up, subscribe if you're not, and I'll see you all in the next one. Bye bye.